All right, welcome everyone. Thank you all for hanging tight. Welcome to our webinar. We're really excited to have everybody. I know this was open to some of our affiliate chapters of NGLCC around the country. So for those of you that might be new to NGLCCNY, welcome. We're really excited to have you. We have a really great lineup of panelists who are bringing some incredible knowledge to something that is on everybody's mind, which is the new stimulus package. First, I need to shout out to TD Bank, our incredible partners at TD Bank who helped us put this together. We are so grateful for your partnership, and we're excited to hear from you as well. So I'm excited that we're going to be having Steve Garabell and Barton Jackson from TD Bank, Clarence Campbell from Lindustry, Lou Pizzalio from Grassy, and Brian Auerbach from Paycor. So they are all bringing a lot of information. And for those of you that are watching this as a recorded session, please know that you can always reach out to info@nglccNY to be connected with anyone or if anything changes in the near future. So with that said, and for the sake of time, because I know we have a lot to cover in a short amount of time, I'm going to go ahead and hand it over to our incredible TD representative and partner, Steve Garabell. Take it away for us.
Thanks so much, TJ, and thank you all for spending your Wednesday afternoon before the M3 with us learning about the stimulus package. And I know it's a crazy thing to navigate alone. So we're going to go through, and I have the people on the webinar with us today are great partners to us at TD Bank, and they are great partners to our customers. So we wanted to share their knowledge and their impact that they're making with our clients and our communities to help all of you out with this. And I'm going to share my screen now and we'll get started. Barton, if you want to say hello also. I think you all know Barton. Here we go. This is the part I'm not good at, but all right. So welcome. So we're going to, go through pieces of the new stimulus package. And, one of the things that we really wanted to focus on before we started was, we want you to, internally think about who's on your team. And, you have your employees, but who's on your business consulting team? And, your team really needs to be built up with, a banker is a good person to have on it. But they can only give you certain advice because of what they're legally allowed to discuss. Your accountant is a great person to have on your team, and they're definitely someone that you want to think about having a close relationship with, especially when you're going through identifying pieces for relief. We have Lou on the phone today from Grassy, who is our CPA partner over at TD. You also want to think about having, besides a banker, different types of lenders as part of your team. We have Clarence with us today from Lindustry, which is an amazing fintech-powered CDFI, and he'll tell you lots more about that when he starts. And also your payroll company is really important, especially when we're talking about PPP, to help you kind of stay stay correct and make sure you have all the right resources that you need. So Brian works with TD's payroll partner, Paycor, and you're definitely your payroll partners, a good person to have on your team, along with your attorney and, some technical assistance providers. The Small Business Development Centers of America offer free technical assistance, and they can help you as you're looking at the relief programs that we're going to talk about today. They can help you put your applications together and get access to relief, and it's free to use their services. So we're going to start with what everyone is here for, I'm sure, the PPP. We've heard a lot about it, and it's come through many different variations. We've seen 3 pieces of funding coming, and I have to tell you, in the years that I've been in banking, I've never seen something change so quickly. Every day we'll get updates on process and things that are happening with it. And there's 2 types of PPP this round. So you have your first draw and your second draw. Your first draw for people who haven't taken advantage of a PPP loan yet. And that's something that if you haven't and you qualify, and Clarence is going to go through a little bit more of that in his presentation, you want to take advantage of that. The second draw is also something that's available now. So for borrowers that had the opportunity to access PPP relief in the first round, there is an opportunity for the second round, but it's not as streamlined as the first round because you have to prove a need this time. So you have to demonstrate at least a 25% reduction in gross receipts from one quarter over the next quarter. So if it was quarter one of 2019 to quarter one of 2020, or vice versa, quarter 2, 3, or 4. And you have to previously had received the first draw PPP loan and used all of it. That's really important. The good part is that they've added more covered things into the second draw that you can use the funds for. So it's definitely beneficial. And you have to have no more than 300 employees. And as I said, Clarence is going to go through a little bit more in detail on this, but feel free if you have questions, make sure you keep them because we definitely want to help answer them. And then Bart, I'm going to turn it over to you to go through 2 other pieces of the CARES Act.
Thank you, Steve. Are you able to hear me?
Yes, we are.
Okay, wonderful. Sorry I don't have video right now, guys. We're having some, I think, graphic drivers issues with my web camera.
Barton, you muted.
Oh, sorry. We're back.
You're back now.
Okay. So one of the 2 major pieces of relief was the economic injury disaster relief loan. And, most of New York was waiting for this to be part of our zone with the New York State on Pause initiatives, and became a very popular tool, and probably by its own volume overloaded the Small Business Administration. But the Economic Injury Disaster Relief Loan, also known as EIDL for short, is a loan that is applied for directly with the U.S. Small Business Administration, or SBA for short. It is a term loan, so it is not forgivable. It is underwritten. And as such has credit guidelines administered by the decisions of and the guidelines of the U.S. Small Business Administration, and potentially can be repaid up to 30 years with no prepayment penalties or fees. At first, it was available for for-profits at 3.75%, and then as well for nonprofits at a rate of 2.75%. And that is a fixed rate for the duration of the loan. It could have been used for working capital, normal operating expenses, and as such, required you to complete an application and provide documentation to back up the loan request. It was for loans over $25,000, and would require collateral at that point, which was something that maybe some business owners were not prepared for. The SBA is oftentimes a partner with many lenders through the 7A program, and likes to put their hands on things when they're providing either a guarantee or a loan. So just like a traditional lender, there is a request to put collateral under lien, things like machinery or equipment, but also what's commonly known as a blanket asset lien against a business. So anything that would be considered collateral or an asset could be collateralized. As a result, it's a true loan program, so it wasn't part of the loan forgiveness portion. But what is the EIDL advance. So if you recall back to what seems like a decade ago, there were about around April through June, people were kind of getting a 2-stage process to their EIDL applications. There was the opportunity to get an advance, which was solely based on your payroll, and then a follow-up to that where the process was asking if you wanted to have additional financing. So there was the advance, which was a grant that could be forgivable, and then there was the actual true loan, which came after. The advance funds, under the CARES Act and in line with PPP, were not forgivable in the sense that when you apply for forgiveness with the Paycheck Protection Program, this amount could still hang on. So even if you got fully forgiven on the Paycheck Protection Program, if you got $10,000 on the EIDL advance, you were still on the hook for $10,000. That changed with the most recent stimulus bill. So now that amount is fully forgivable as well. The other thing that's really important about the EIDL loan is that for any borrower that's interested, there's deferral up to 1 year where interest still accrues, but you can make payments earlier if you choose to do so. So for many businesses in the metros where there was a pause, but then a reopening of the marketplace, if you had the cash flow, you're able to do so. Steve, if you could go to the next slide. The other part that was really a boon to business owners is if you were an existing borrower in a SBA guaranteed loan, was the debt relief. So Uncle Sam was making direct payments to your lender for 6 months. And that was for loans that were made after March 27th of 2020, and as long as they were fully dispersed by September 27 of 2020, even those loans, that were on the books, were getting 6 monthly payments. So, one of the things is if you were the benefactor of this particular piece of stimulus, make sure that you're checking in with your lender too, because you may have had to make arrangements to either reauthorize if you were on automatic payment deduction, or how you go forward with billing an invoice once Uncle Sam was done. And finally, with the Economic Aid Act, we're looking at additional debt relief payments on all 7A programs, microloan and 504. The level of assistance kind of varies on when the loan was provided. So that is something you would have to check with your lender. And it's looking to be implemented into the standard operating procedures for the SBA beginning on or after February of 1st of this year. So make sure that you reach out to your lender or the assistance of your SBA support providers like your technical assistance experts.
Wonderful. Well, thank you for sharing. That was just a very high level overview of the 3 vehicles inside the CARES Act. And we're going to turn it back over to TJ, who's going to introduce our next presenter.
Yes, I'll happily do that if I can find the mute button. Apologies. All right. Thank you so much, guys. That was awesome. That was awesome. Just quick reminder, if any of you have any questions along the way, please put them in the Q&A feature, and we'll do our best to either answer them on the back end, or we'll address them during the Q&A section at the end of this session. So up next, we have Clarence Campbell of Lindustry. Clarence, are you off mute? All right, I'll let you take it away.
Awesome. Well, thank you, TJ. And again, thank you to NGLCC New York and TD Bank for the opportunity to present and speak today. My name again is Clarence Campbell, and I'm the Executive Vice President of Sales for Lindustry. So let me just start, share my screen, and we'll jump right in there. Great. And so just a little bit about Lindustry and who we are. Again, as Stephen shared, we are a partner with TD Bank and excited to be here today. And I don't know why my screen is not advancing here. Bear with me 1 second. Okay. And so Lindustry is, we are a minority-owned, technology-enabled community development financial institution. And basically what that means is that we are mission bound to serve and support the underserved community. And we do that in a number of ways. We do that primarily by providing small businesses with education and access to capital. And again, part of our positioning as a CDFI and a technology-enabled CDFI really puts us in a great position to partner with organizations like TD Bank and others to really provide support to the small business community that really has an impact on not only production on the business side, but job creation and retention, which is really what we're going to be talking about today with the Paycheck Protection Program. Just a few of our certifications. Again, we're certified by the Department of Treasury as a CDFI, as well as a CDE, which is a community development entity, which basically provides, again, access to the Treasury. And then we are a member of the Federal Home Loan Bank of San Francisco and a direct lender for the SBA. So again, part of our role and our function as a lender is really to support organizations, not only with our standard lending platform, but also through the services of the SBA and supporting the Paycheck Protection Program loan. And again, one thing that makes us a little unique, different from other CDFIs, is that we use technology. So we're a fintech CDFI, the only fintech CDFI in the country. And basically it allows us to use our proprietary technology to really partner with other organizations, as well as to provide efficient deployment of capital in a scalable way to really support small businesses. And our impact in the community, as you begin to look at what we've done over the past year, we provided over $500 million in capital deployment to small business owners and supported over 78,000 jobs. So again, today we're here to talk about the Paycheck Protection Program, and I'm going to provide an overview of the Paycheck Protection Program and talk a little bit about how that works, and then share some tips for applying for those that are interested. So first and foremost, I think it's important to note that the Paycheck Protection Program was designed to provide access to capital to small businesses in the form of a loan that can be forgiven. So the purpose initially really is for the loan to be forgiven when you meet certain requirements, and I'll review those in a moment. But it's important to note that there is no personal guarantee required for the loan. There's no collateral required for the loan, and your credit score does not have an impact on the credit decision, on the approval of the loan. As Stephen shared earlier on, there are two types of borrowers in this round of Paycheck Protection Program. There's what's called a first draw borrower, and that is an organization that never had a PPP, so was not funded in the first round of PPP and seeking their funding for the first time. And then there's a second draw, and we'll talk about that in a moment and some of the differences, but the second draw are applicants who were funded in the first round and now seeking funding through a second draw of the Paycheck Protection Program. It's also important to note, I talked about the loan really being forgiven. So it's really important to understand the basic concept of the forgiveness. And that really hasn't changed for the first draw from round one to round two. The loan proceeds are based on, and your loan calculation is still based on your average monthly payroll. And the loan must be used at least 60% has to go towards payroll costs. So the funds that the loan that you take, at least 60% has to go towards covering the payroll costs for it to be forgiven. SBA does allow for up to 40% to be utilized on other expenses, such as interest on mortgage payments, to pay other debts, leases, as well as utilities. You can also use it to cover certain operational expenses as well. And it also allows you to make repairs for vandalized properties and also provide for payment of worker PPE. So they have expanded the uses a bit this round for the Paycheck Protection Program loan, but it's important to note that, again, to achieve forgiveness, at least 60% must be used for payroll cost. So as we begin to look at the first draw and talking about who's eligible for the first draw, so it's important to note that just in the first round, small businesses are eligible for first draw loans, businesses of different entity types, as well as independent contractors. And sole proprietors are eligible. And we'll talk about this in a moment when we get to the calculation piece, because that was a point of confusion for sole proprietors in the first round. But again, independent contractors and sole proprietors are eligible to apply. Also, businesses, nonprofits such as 501c3, 501c19s, tribal businesses are able to apply as well, as housing cooperatives and news organizations. Some news organizations are eligible to apply. It's also important to note that, like in the first round, organizations with 500 or fewer employees are eligible to apply for the first draw paycheck protection program. And then one other important note is that the business must have been in operation on February 15th, 2020. And this is a hard date. So if the business was started after February 15th, 2020, the entity would not be eligible to apply for the Paycheck Protection Program. So how do you calculate your maximum loan amount? And this hasn't changed from the first round. You still look at your average payroll, your average monthly payroll, and you're looking at the payroll costs that are included. And so as you look at your average monthly payroll cost, once you've determined what that is, you then multiply that number by 2.5 to get your maximum amount that can be borrowed through the Paycheck Protection Program. It's also important to note that if you wanted to include the EIDL loan that's made between January 31st, 2020 and April 3rd of 2020, that gets added to the Paycheck Protection Program, then the maximum amount you can borrow is $10 million. It's still the case for, same case for seasonal employees. For the first draw, 2.5 is still your multiplier. One of the differences, however, if you are a seasonal employee, is that you use a 12-week average versus a 12-month average of payroll to calculate your average payroll. And we give a definition here of what a seasonal employee is per SBA. It's a seasonal employer is a borrower that does not operate for more than 7 months in any calendar year, or for the preceding calendar year, had gross receipts for any 6 months of that year that were not more than 33% of the gross receipts for the other 6 months of that year. So again, the providing the definition of a seasonal employer. And one thing that's also important to note is in this round, you have the option to elect to use your payroll from 2019 or 2020. So borrowers have the option to elect which year they would like to provide for their payroll verification. And again, you calculate your average monthly payroll cost by looking at the payroll costs that are included and subtracting excluded payroll costs. The second draw, it's important to note that there are some differences on the second draw. And so as you begin to look at the second draw, first and foremost, to be eligible for the second draw, you have to have had a first draw PPP. So again, this is reserved for organizations that were funded in the first round of PPP. You have to have used or will use the full first draw PPP loan amount on eligible expenses before disbursement of the second draw. So again, it's important to note that all of the funds have to have been dispersed in the first draw before using in the second draw. Also for the second draw PPP, it's 300 or fewer employees. So organizations that have 300 or fewer employees would qualify for the second draw PPP. And then also, there is a requirement to verify that the organization has experienced at least a 25% or greater revenue reduction in 2020 relative to 2019. And again, so what's important to note here is that you only have to show a 25% reduction in gross revenue for at least 1 quarter. So you can really show this in 5 different ways. You can use either quarter 1, 2, 3, and 4 profit and loss for 2019 and 2020, or you can show it as an annual. So using the profit and loss or tax returns from 2019, 2020. One of the things I do want to point out here, and this goes for the first draw as well as the second draw, that was a little confusing for some borrowers in the first round, is as it relates to sole proprietors. So again, the loan is calculated based on average monthly payroll. So you can only use employees of the organization. And most organizations will verify that with a payroll statement, as well as what's known as your 940 and 941s, that you report the wages that you've paid. And it's important to note that those organizations can include wages as well as the funds that the organization pays towards benefits such as health insurance, disability insurance, as well as retirement costs. But there are some organizations, such as sole proprietors in many cases, that may not have employees. And one of the things that we found in the first round was that this was confusing because many sole proprietors were not aware that they could apply without having employees. But if you are a sole proprietor without employees, we look at, to calculate your average monthly income, average monthly payroll, we would look at your Schedule C, which reports your net profit. So again, your Schedule C is just your profit and loss. It's in your tax return, typically under your 1040. And on line 31, it will show your net income. To calculate your average monthly payroll, you would take that net income, which is income to the owner, and divide it by 12. And that becomes the basis for calculating your maximum loan amount for the payroll protection program. It's also important to note that if you have employees, you're a sole proprietor with employees, you are still able to include the net income from your Schedule C. So just wanted to provide that because that was a little bit of confusion in the first round. The other part that was confusing was the purpose behind organizations not including independent contractors. So you cannot use independent contractors in your payroll calculation because independent contractors are eligible to apply on their own behalf. So they are excluded from the calculation for payroll. So just wanted to provide some of that clarification there. As we begin to look at the calculation for the second draw Paycheck Protection Program, it works like the first draw. However, there are a couple of differences here. Again, 2.5 is the multiplier. However, if the organization has a NAICS code of 72, and that's for businesses that are operating in the accommodations and food service industry, there is a higher multiplier. So you would use 3.5 as your multiplier if you operate under a NAICS code of 72. The maximum loan amount would be $2 million. But again, the same goes in terms of how you would calculate that for seasonal employee as well on a 12-week period. And then the same payroll costs are there as in the first draw. So just important to note that distinction, the big distinction again, just to review for the differences between a first draw and a second draw is that in a second draw, you have to verify that there was a 25% reduction in gross revenue. And then in the second draw, it allows for a higher payout, a higher multiplier, if you operate under NAICS code of 72. So one of the things I just want to wrap up on and share are just a few tips for applying. And what I have here is our partner link that provides resources for applying. So a couple of things to point out here. If you visit this link, and I know this information will be shared, but if you visit this link, it actually will provide a couple of things. It provides information on the first draw and second draw loan. So you can find out what is the eligibility requirement for first draw and second draw. What are the documents that are required? That's a big thing. That's a big question mark for many employers is what documentation will need to be provided. You can verify that here on this page. There are links that you can click on that will provide that information. And we also have a full guide for the Paycheck Protection Program that again goes over the documentation by entity type. You'll also be able to get a deeper overview of the Paycheck Protection Program, and as well as it provides helpful tips and screenshots of how to complete the application. One of the things that's really important to note here on this screen through this link is while the application and the guide that we provide are only in English, there is a translate feature here. So the materials that are laid out on this page can be translated into other languages. So again, just want to provide that information as a helpful tip. We again are excited to partner with the residents and businesses here in New York. Obviously partnering with NGLCC and TD Bank. We have also provided contact information. If you have questions, you can feel free to reach out to myself or my colleague, Ronald Sims. So with that, TJ, I'll turn it back to you.
Awesome. Thank you so much, Clarence. That was such a great deal of awesome information. Thank you so much for sharing that. I think something I've been taking away as I've been taking notes that reminded me was something that Steve said, and I would love to put on everybody's radar, and that is, who is your team? And that is such an important thing. And I think through COVID, we realized the importance of having these relationships with these specialists and how important it is for your business or your industry and as you grow your community and your business. And I would encourage all of you to remember, that's the important part of being part of a chamber of commerce, is that you are growing that network and that team. So if anybody's interested, I will put the link to this evening's Members Monthly Mixer, or M3. If you are interested, I know there's some new people here. If you are interested in coming and seeing what nglccNY is all about and starting to grow your business network, we would love to have you join us. So please, I put the link in the email. It will be at 6 o'clock this evening if you would like to join. All right. Thank you so much, Clarence. Well, next on our list, we have Lou Pizzilio from Grassi. And Lou, I will kick it off to you to take it away.
Sure. Thanks so much, TJ. And thanks, Steve and the TD gang for inviting me to join you in presenting this important content. I'm Lou Pizzilio. I'm a partner at Grassi. We're a full-service accounting and advisory firm. We've been helping our customers, friends, and community with PPP and all the related stimulus from the beginning of the CARES Act. It doesn't feel like it, but it's been almost a year now. I can't believe that we're still talking about this. I think when the original CARES Act was drafted, there was a magic date of June 30th, which I think they believe by then it would have been over. So who could have forecasted that we would be a year in and still talking about additional stimulus, more, in addition to what we're talking about now. I think there may be a PPP 3 and 4 as it looks right now. So I feel a little bit like Ron Popeil because there was a lot covered, but I want to say, wait, there's more. There's, the Consolidated Appropriations Act, which was passed at the end of December, put forth, more stimulus than even the CARES Act did. It added quite a bit. I mean, these two bills are bigger than the New Deal from the 20s and 30s. I'm still baffled by the amount of aid that the federal government has put forth. And like I said, I think there's more behind that. So Brian, I think after me, is going to talk about the employee retention credit. It's a very, very rich credit. Prior to the Appropriations Act, as a PPP borrower, you weren't qualified, but you are now. He'll get into a little more of the details, but it's definitely worth a look. The other thing I wanted to mention is the shuttered venue operators grant that was part of this bill. It's not a widely publicized or talked about piece of the aid, but if you're operating a theater or a Broadway-like operation where you have events with performers in the art space, this is for you. and you should be looking at it. It's available through the SBA's website. It's not administrated by the commercial finance community. It's directly through the SBA. So if that's you, it's worth a look. In addition to all the things that were talked about already, the act did one more thing that everybody was hoping it would, and it made the PPP forgiveness completely tax-free on a federal basis. So your loan forgiveness is not taxable, nor are the expenses a loss deduction. So from a tax standpoint, federal tax standpoint, there is no impact. One of the important things to pay attention to is not all states are following along. New York and Connecticut have said, yes, they will follow along. We're still waiting on New Jersey. It's still a very dynamic area. The states are a bit starved for revenue, but it's also unpopular to tax this part of the aid. That wasn't the legislative intent. And there was a lot of back and forth, but we finally got there. So that's great news. The other thing I want to talk to you a little bit about is the forgiveness process. As you know, and as was stated, these PPP loans are really grants that are disguised as loans. The federal government chose the 7A loan program to administer these grants. And if you use the loan, if you use the proceeds of the loan as designed, you're entitled to forgiveness of the loan. And I know there's been a lot of talk about it. So just at a high level, you do need to spend the funds in a 60-40 fashion, payroll, non-payroll. It doesn't operate like a cap, it's more of a collar. So for every 60 cents of payroll that you spend, you're entitled to spend another 40% on non-payroll costs, but you can choose to spend all your amounts on payroll. And with the loan size set off of 2.5 months and the covered period by which you measure forgiveness set off of 24 weeks, it's likely you may be able to use just your payroll. However, it interacts with the employee retention credit, so you may choose to use some of the other expense categories as well. And they did expand those out quite a bit. So the covered period is the period from when your loan originates to 8 to 24 weeks later. So you have a choice of your covered period. You can end it 8 weeks or up to 24 weeks after the loan is funded. You'll collect your payroll expenses, your non-payroll expenses. Your lender's platform will open for the forgiveness application. You'll then go on and fill out and upload some documentation and sign some certifications. At that point, the lender has 60 days by which to approve your application for forgiveness and forward it to the SBA. The SBA then has 90 days to pay off the bank. And at that point, your loan is forgiven and you'll receive a notification from your lender. That is the same process for PPP1 as it is for PPP2. There is the timing of which will be interesting. Our counsel to date on PPP1 has been to hold off on forgiveness, especially for the larger loans where the SBA has said they definitely will audit. As we get more information as to what that process looks like, there is a cause for pause to be strategic. The employee retention credit is the perfect example. If you filed for forgiveness before the retention credit became available as a PPP borrower, you may have chose a different pool of expenses than you would have otherwise, knowing that that payroll could be used for employee retention credit. All of this stuff is very complex. Operating a business as a business owner in a crisis situation can be very, very isolating and require a good deal of brain power and brain damage. So as everyone said, counsel with your advisors on these things that are not part of your sort of daily operations makes perfect sense. And, choose whoever that is, whether it's your mother-in-law or your accountant or your attorney or your friend. It makes sense to kind of spend an hour, think about this strategically with whoever that group is, and then pursue some of the stimulus. It's out there. The program over the past year, the changes have made it easier and richer, and really have gotten more close to the legislative intent of making this as easy as possible to achieve forgiveness. So I encourage you to work with your advisory group, and anyone on this call, if you don't have that person in your group, to get you to take advantage of all the stimulus that's available, including PPP loan forgiveness. And with that, I'll turn it back to TJ.
Awesome. Thank you so much, Lou. All right, everyone. I do see that we do have some excellent questions trickling in the Q&A session. We will do our best to answer those offline while we're going along, but we will address as many as we can at the end of the session. Also, if you're watching this on one of the social media streaming platforms, or you're watching a recording, just a quick reminder, please reach out to info@nglccNY.org if you have any questions, if you were concerned if anything has changed over time. info@nglccNY.org. All right, next I would love to bring up Brian Auerbach. Brian, welcome.
Thanks, TJ, and thanks Lou and Steve and Barton and Charles for the presentation so far. So I'm with Paycor. I run our Bank Alliance partnership with TD Bank, and so we have a great partnership with Steve and Barton and the rest of the crew over there at TD. And I also do a lot of work with Lou and his team over at Grassi as well. A big part we'll talk about is leveraging your payroll company. So just a little bit about Paycor before I get into that. So we are the fourth largest and largest privately held payroll company in the United States. A big piece of what we do is partnering with your advisors. So the one thing that I hear as a constant theme is counsel with your advisors, talk to the people, whether it be your bank, CPA, attorneys, financial advisors, insurance brokers even. A lot of these people have resources that are available for you. One of the things I was going to mention is we're going to go talk about the employee retention credits now. Is Paycor will help you get the information. We'll tell you what information you need, but we won't counsel you on that. And a lot of payroll companies are the same way. We'll say, go talk to Lou or go talk to your attorney, et cetera, about that. So kind of good to have those extra people involved, and also have the integration where someone, a CPA or any other advisor, can dig into your payroll system and pull that information and help disseminate what these numbers actually mean to you. So that's just a big piece of it. I'll kind of just get into a little bit about the reporting functionalities of stuff as well. It's a lot easier to do real-time reporting than it is to do forensic reporting. So if you're not keeping track of how many hours per se an employee is working, whether it be a waiter, it could be a senior salesperson, or any kind of consultant that you have that you're paying as a W-2, if you're not keeping track of that real time to go back and figure out how you're breaking that down per month, or if a commission, et cetera, those are very tricky things to figure out. If you didn't put the information in when you did it, it's going to be very difficult a year later to figure out what exactly happened. Most of you probably don't remember what you had for lunch yesterday. I don't remember what I had for today. So those are kind of the concept of what we're talking about. To talk about the employee retention credit though, this is really where the government is saying, thank you for keeping people on during COVID, even though times may have been tough. So there's a lot of different things in there for companies. I'll talk about the under 500 because I think that's the majority of the folks on the call today. This is for the first 2 quarters and or both, with a top retention credit of $14,000 or $7,000 per employee, and it's $7,000 of qualified wages it's against the Social Security tax, basically. Lou, am I saying that properly? Just good. As long as Lou gives me a thumbs up, I know I'm doing a good job. So
yeah, I'll just add the credit is actually over and above what the FICA tax is. So it's more than a credit. They should have called it a subsidy. They're actually subsidizing the payroll in excess of the FICA credit.
Yeah, and it's a real-time subsidy too. So it's something there for you. And again, if you're reporting very clearly on your payroll and you're putting the information in, it's very easy to apply for and get these credits. And something, because a company like Paycor, we're partnered with 8 of the top 20 banks in the United States. We know when these loans are coming out. Companies like banks like TD and Grassi tell us, hey, we need these reports right now. And because of unified platforms, we're able to get that reporting up to you in real time, so you can get those credits as soon as possible, so you can actually operate your business. So it's a big piece of what's going on. But I'll turn it back over to TJ, kind of open up to more questions. I'm sure there's going to be more questions that are probably going to be oriented to Lou on the retention credits.
Awesome. Yeah, the time has come. I know, Lou, you've been diligently trying to answer some of these questions on the back end. So thank you for that. Great. I will go through a few of these. First question we have is, can a 501c4 organization apply for loans? And whoever is best able to answer that question, we'll just leave it open to anybody.
So I'll take a stab at that. The 501c4 is not listed as an eligible nonprofit for the PPP. So looking at the SBA guidelines at this point, they're not listed as an eligible nonprofit for PPP.
Yeah, 501c4 is considered a member organization, so it's a conglomerate of the members into one larger nonprofit. So thus, a 501c4 really rarely should have employees.
So PPP2 added, or the recent act added C6 organizations. But yeah, I was just going to look up whether C4 is in that pool. And I think because it's a member organization is why it's sort of excluded specifically.
Okay. Next question we have from David, and I think, Lou, you said you were going to take a stab at this one. If I have a new employee that started in September of last year, can I include their real monthly cost, or do I have to divide their 4 months of salary by 12 when determining the PPP loan amount?
I'm laughing because I hit answer live by accident. I couldn't go back. I was going to type in the answer. The answer is technically yes. But the practical answer is it depends on the lender. I will tell you in the first round, we did this often for folks that we counseled, and many of those loans got approved for additional amounts that they would have otherwise not got approved for. It really depends on what the lender is willing to do. And in the second round, I know the SBA is being more diligent on the review and not really leaving it up to the bank. So I guess the real answer is, well, technically, yes. The practical answer is, that depends on the lender.
And as the lender, I'll share that we would look at it over a 12-month period. So we're going to look at the documentation for your average monthly payroll over a 12-month period here at Lendistry.
Awesome. All right. Next question from Liz. PPP1 had the specific time frame in which you needed to use the funds in order to qualify for forgiveness. Will there also be specific time frame in which PPP2 funds would need to be used?
There is, and it is the same. It's the date commencing when the loan is funded, or the first payroll period, the first day of the first payroll period after the loan is funded, to 8 to 24 weeks later. So I don't know if you remember when PPP first came out, the first iteration was just 8 weeks, which made it very, very difficult, especially in the restaurant community, and many of those businesses were closed. It was extended to 24 weeks, which I think partially mitigated that, but I think there's even still some businesses that had struggles. But yeah, so it's simply from your origination date of the loan to 8 to 24 weeks later.
Okay. It looks like we've answered everything, but I would love to open it up. If anybody has a question they would like to answer live, if you could just use the raise hand feature, we're happy to allow you to answer that question live. I'll give you a couple seconds to see if anybody wants to do that. I know it's putting everybody on the spot when you're all expecting to hide behind the screen. Let's see. Okay. It looks like everybody was really thorough. I'll leave it open in case you want to answer a question, but I would love just to open it up to all the panelists to see, now that we've all listened to each other and we've answered some questions, are there any thoughts or things you would like people to take away that they should consider now that we've all put our forces and knowledge into this table?
I'll just add, I think there's so much available. If you're a business owner that hasn't gotten any aid, there's something that you're not taking advantage of, whether it's the EIDL loan, which, it's really, to apply for it on the SBA's website is probably a 20 to 40 minute exercise at most. It may take some time. The SBA's backlog, so patience is important. But the employee retention credit, being that it's a payroll tax credit and it's not an income tax credit, is available to everyone. We've spoke to many of our not-for-profit clients. When they hear tax credits, they don't get excited because they're not-for-profit. They don't pay income tax. This is not an income tax credit. It's a payroll tax credit. Whether you made money, lost money, or don't pay any taxes because you're a not-for-profit, this credit's there, to take advantage of. And it really is more than a payroll tax credit. Many folks don't pay $5,000 per employee in FICA, but you still get the full credit. So it's more of a payroll subsidy. And it was put forth for those folks who maybe needed some more aid or couldn't take advantage of PPP. The number of employees calculation and the affiliation rules for the ERC, the Employee Retention Credit, operate significantly different than the PPP rules do. So it's a broader audience, and really I'm probably talking upstream. So certain larger employers or affiliate groups may qualify for the ERC that did not qualify for PPP. The SBA loan payment coverage, a lot of small businesses use SBA 7A and 504 loans. The fact that the SBA is making those payments for you, think if you're a restaurant or accommodations, an NICS code 72, they'll even make bonus payments. I think it's up to 8 payments for that class of borrowers. And that's in addition to 8 that they've already made. I mean, that's a lot of money. So there's a lot out there. And I think the counsel of, speaking to whoever, talk to whoever it is you talk to help you through this. And if for some reason, in the accounting world, there's, some accountants kind of sat on their hands when this first started happening and they're a little behind the curve. And then there's all accountants of all different sizes and scales. If you're not getting the help from your team, find it with your banker or your attorney or another accountant or whoever it is you need, because there's a lot out there to take advantage of.
It looks like we actually have some questions rolling in that we can maybe address because we still have some time. Let's go ahead and take one of these. This is from, let's see, I had one employee through 2019 and 2020. As of last week, the position is open. Am I eligible?
So the thing that keep in mind with forgiveness is that you have to maintain staffing levels. So just keep in mind of where your staffing level is now versus where it will be after the loan is funded, because you will have to maintain staffing levels. So it sounds like maybe she's going to replace the position, but you have to maintain staffing levels. You can't go down. And that would be the biggest impact there.
I will say that the loan size is set off your 2019 payroll. So if you had one employee, you'll qualify for the loan. Likely as I don't know what the structure of the business is, but there's also likely could be owner compensation included in the loan size, like we spoke about earlier for sole proprietors. And there's tons of safe harbors that if you're not able, if that person left voluntarily and you haven't been able to rehire them, you still may be eligible for forgiveness. So it's worth a discussion with a lender or kind of going through the application. Because even if you don't take advantage of the grant portion, this, PPP, if it isn't a grant, it's still a really, really low cost, super duper source of capital. If it doesn't become a grant, it's a 5-year loan at, I think, 1%.
It is 1%.
Give me as much money as you will at those rates. I'll take it. Just, drop it in my mailbox. So even if it's not a grant, it's still a really good loan.
Awesome. Thank you. I'm going to try to fit in 2 more questions if I can before the end of the time. From Kevin, after applying, how long does the process usually take from application to funding? Sorry if this was covered, they missed it.
No, it wasn't covered, and that's a good question, Kevin. What I will say is that's a hard question to answer right now in terms of applying from application to funding, because SBA has adjusted the requirement process for getting SBA approval. So just to understand that your lender still has to work through SBA to get approval to fund the loan. And so that could take some time to get that information. So it's a little bit tougher to answer that question because it also varies from one lender.
Yeah. And also the portal's just pretty much opened for most lenders a week ago. So the influx of applications has been outrageous. So, that also helps, that doesn't help the quickness of the lenders, because before they can disperse the funds, the SBA has to sign off on the deal. So that, it does take some time. But I can tell you that every lender I've seen has teams working around the clock on them.
Awesome. Okay. Last question. Is the payroll tax credit available to sole proprietors using the Schedule C income to compute PPP loan amounts?
To be honest, I'm not sure, but I believe it's only where you paid FICA. So as a sole proprietor, I think you still do pay FICA. So it may be available for you as an employee, but I'm not certain. I would have to look that up.
Okay. We have one more question. We're just going to try to cruise through it, so we got to everybody's question. If my 7A loan was approved after September 27th, 2020, and before February 21st, 2021, should I expect any debt relief?
I would consult with your lender. The program was for loans that were fully dispersed by September 27th, 2020. And the new CARES Act just came out. So I would consult with your lender to just see if it fits into a program. But I know that they're looking at some new debt relief programs for the 7A also in the upcoming conversations.
All right, with just a minute over, thank you all so much for coming and sharing your expertise. I love nothing more than bringing people together to provide knowledge and share this space. So please, Clarence, Lou, Brian, Barton, Steve, thank you so much. And again, TD, thank you so much for your incredible partnerships. I'll open it up one more time to the panelists if they would like to bid us adieu. But again, thank you all so much. Awesome.
Thanks, TJ.
Of course. Well, everyone, remember the link for the M3, if you'd like to join us at 6:30, is in the chat. Thank you again for coming. Everybody have a great night and stay well.
Thank you, everyone.
See you in a little bit.